Sometimes I wonder, has it always been this contradictory when it comes to all these news about recession and pivots and pauses and all that stuff? Are we really in a recession, or is it just all for naught? Guys, what I'm about to show you is absolutely insane because, well, a lot has happened in just the past 12 days of the beginning of the month. And I'm fairly new when it comes to investing in the grand scheme of things, right? I started investing when I was 21 and currently I'm 27, so only about 6 years. Now, I really truly started an actual strategy and knowing the whole concepts of, like, you know, what is a dividend, options trading, fairly recently, ever since 2020. So I'm not fully aware if it was always this contradictory. Now, you guys can point to, 2007, 2008. I was like 12 years old back then, so I had no concept of this. But I really am curious because, well, you guys are seeing this article right here that's showing it's happening, the recession is here. From Demir Tokic, pretty much saying that, like, he believes that recession is here, but also at the same time, guys, we got job numbers exceed expectations for the month of April. And it's just a complete mess. Every single time I pull up a story, there's a recession, there is another story saying, or numbers showing that this is actually not going to happen. So that's essentially what I want to talk to everybody today about, what's going to happen here, because, well, it's a very interesting to say the least. Now, before we get started, please make sure to hit the like button, subscribe, comment, and of course, share. The best way that you guys can help us with this endeavor is just, again, like, subscribing, and of course commenting. Thank you so much for everybody who watches, and we're gonna try out this new format for today. So I'm home, the market is not yet open, it's actually about to be pre-market in about 5 minutes. I'm recording this as of 8:55 a.m. You guys will see this at around like 11 or pretty much whenever I'm done editing it. But let's try out this new format, right? Let's try out this new format. We're gonna go over a couple of news that's currently happening. I want to go over actually a really important news that I put out in my community post, but I really want everybody to see. And lastly, we're gonna go over one stock analysis, a really quick one, nothing too major, of your choosing, right? Of your recommendation. So we're gonna spin the wheel, and then we're gonna do that one. So with that said, let's get started with this video. So, as I said, guys, a recession is expected in Q2. Again, this is from the same article by Demir Tokic, and he's pretty much just saying at the end of Q1 2023 on March 31st, I wrote an article, the recession is expected to start next week. Based on the forecast by several major Wall Street firms, the term next week meant Q2 of 2023, i.e. what we're going through today. He continues on to say, in fact, my own proprietary research has pointed to a recession by October 2023. Based on the signals from the bond market and a probit-based econometric analysis, but these were just forecasts, and nobody can predict the future with certainty. Thus, as my major conclusion on March 31st, I cautioned that the near-term recession will have to be confirmed with the data. Wall Street does not expect a sharp increase in unemployment rates, but we do have to see some weakness in weekly initial unemployment claims. And that right there, guys, is a major point. So, okay, he's saying that the recession should come in by October 2023. Okay, well, by October, we're going to start seeing the numbers from Q2, which was his initial claim. The problem with all of this is that, well, guys, job growths totaled 253,000 in April, beating expectations as the US economy slows. How does that make any sense? Like, I just showed you guys an article from somebody who says a recession is coming, and in this CNBC article, you literally have a headline that contradicts the initial statement of the headline. This doesn't make any sense. Job growth totaled 253, as you can see right here, estimated growth of 180,000, okay, 180,000. Yet, look at this, it beat by a significant amount. And then it says, as the US economy slows. How is it slowing when job growths are 253,000? That's absolutely insane. Again, beating expectations. And on top of that, we can actually see over here this other point. The unemployment rate was 3.4 against the estimate of 3.6. And in fact, I believe that the previous unemployment was 3.5. So it's gone down again. And look at this as well. Average hourly earnings rose 0.5% for the month and increased 4.4 from a year ago, both higher than expected. Everything here is actually leading to say that we're not going to be in a recession. Now, obviously, this is just solely based as of April 2023, right? But the thing is that April 2023 is still Q2, right? We're technically, so all of these numbers that we're getting is based off of Q2. Now, the earnings, when it comes to companies, we get those in Q3. I get that, but solely when it comes to job growth, unemployment, we already start to see, we are already seeing the fact that, well, it's not really happening in a way which is very, it's just weird. This is very, very strange because it honestly doesn't look like we're going into a recession to begin with. However, we also have this, guys. Stock futures inch higher. This is as of this morning, by the way, May 12, 2023, 6:55 a.m. Stock futures inch higher after Dow falls for fourth straight session. So apparently the Dow has been falling for a significant amount. In fact, if we come over here, if we take a look at the S&P 500, at the Dow futures or the Dow index, and we go over here to the 5 days, we can see that, yeah, I guess it has been falling on the 5 day, 1.14%. Yet as of this morning, if we take a look at futures, we can see that pretty much everything is in the green, right? Dow is up 0.31, S&P up 0.32, and the Nasdaq is up 0.2. So, okay, stock futures inch higher after Dow falls for the fourth straight session. U.S. stock futures are slightly higher following the volatile week that included worries over the debt ceiling. That's also another major issue, which Mike here has covered a significant amount on the channel. Again, I said that we're going to start seeing a lot more debt ceiling news when we start getting closer and closer to that date. And regional bank health. At the same time of writing, contracts linked to the Dow, INDU, and S&P SPX are up 0.4%, while Nasdaq futures are ahead 0.2%. The debt limit gathering initially set for today between President Biden and Congress. Really? Oh, I wasn't aware that was today. Okay. Including the White House Speaker Kevin McCarthy has been pushed. Oh, okay. Why? Okay, I see. Has been pushed to next week as staff keep negotiating. There was little progress after the group's meeting on Tuesday, meaning the partisan standoff remains as the so-called X date approaches as early as June 1st. At the G7 finance minister meeting this week in Niigata, Japan, Treasury Secretary Janet Yellen also said she doubted whether the 14th Amendment would be an effective solution, saying it's legally questionable whether or not that is a feasible strategy. I'm actually very curious as to why she mentioned the 14th Amendment in this kind of, I guess, solution. Because, guys, the 14th Amendment has to do with citizenship. Not really certain as to why you're implying, I guess, citizenship with the debt ceiling. I'm not fully sure why that would be the case. Goes on to say, in terms of the markets, JP Morgan CEO Jamie Dimon weighed on what the debt ceiling impasse would mean for stocks and treasuries, adding that a default would be potentially catastrophic, and the closer you get to it, investors will panic. At the time, there are renewed concerns about regional banks following the heavy sell-off on Thursday. So, guys, this is absolutely insane. The debt ceiling's coming up. It's quickly becoming major news. I mean, we're seeing it right here. It's still not headlines, though. It's still not headline news, but it is slowly coming this way. And a big factor to this would also be these treasuries, guys. I've pointed this out a significant amount here on the channel. US treasuries, this yield curve has inverted massively. And prior to the inversion, all we read in the news was yield curve inversion, yield curve inversion, yield curve inversion. And now that it's inverted, a drastic amount. I mean, this is starting to make loop-de-loops, guys. You don't hear anything about this anymore. I mean, you got the 3-month treasury having a yield of 5.17. This is higher than any of the other ones, even higher than the 30-year at 3.75. The 12 months is higher than the 30-year. The 2-year is higher than the 30-year. And that's about it, right? That's about it. But the fact of the matter is that the 2 and the 10 guys, from what I hear is that these two, if they invert, it's either the 2 and the 10, or, I mean, if it's the 1 year and the 10 year, then this thing's already inverted. But It's already starting to make loop-de-loops, guys. This yield curve is absolutely insane, yet we don't hear any more news about it. That's interesting, isn't it? That's very, very interesting. Ever since the inverted, it's just completely gone. It's like as if we are trying not to have a recession, but at the same time, all numbers are leading that there is no recession, yet the yield curve is showing that we are going to get into it. This is absolutely insane, which is the reason why I stated at the beginning, I have no idea if this has always been this way. Again, to those people who have been in this game, you know, prior, or yeah, I would even argue prior to the .com collapse, I ask you this question: has it always been this way? Because during the .com, I wasn't even here, right? Well, first of all, I was 4 years old and I was living, you know, I was still in Cuba, because to anybody who doesn't know, I was not born in the United States, I was born in Cuba. And by the time the 2007-2008 occurred, I was like 10 years old, right? So I had no concept of this. So I really would like to know, has it always been this, I guess, contradictory? Because it's looking that way. Now, in other news, guys, I recently covered a stock analysis on Franchise Group, the ticker FRG. So if you guys haven't taken a look at that video, please make sure to check it out. But I did not like that. Well, actually, it was all right of a company. It was okay, right? It wasn't anything major, but it wasn't anything to like, you know, be amazed about. However, as of 2 days ago, I got this article. Look at this. Franchise Group gets $30 per share acquisition proposal. So that's interesting. That was a pretty good shot on my end, making a stock analysis as well as this news coming out. We got Franchise Group has received an unsolicited non-binding proposal to be acquired for a price of $30 per share in cash. The unnamed suitor has offered to acquire all the outstanding shares of the common stock at the company for a price of $30 per share in cash. The proposal is up to review by FRG Board of Directors. The company makes no assurance that the proposal will result in transaction. Guys, this is a company that, again, please check out my video. I don't really remember what the fundamentals were. However, check out their fundamentals, guys. Use the calculator, and if you own this company at a price lower than $30 and you see that their fundamentals aren't that good, you don't like the way that the company is going, it may be in your best position to actually, you know, as a shareholder of this company, you have voting rights. You have the ability to be like, okay, yeah, I want this thing to be actually sold off because I do not want to hold these shares anymore. And if, let's say, you bought it at like $25 and they're willing to buy it for $30, guys, you're going to make that difference based on the numbers of shares that you got. So that might be something that you might consider actually be really, really happy about. Now, if that does happen, if this does execute, your shares will be taken away by force and it will be taken as a taxable event. So it has its pros and its cons, but if you guys take a look at the fundamentals and you don't like it, you might consider, again, if the board of directors approve it, you might consider actually voting yes to having FRG go private. Which, by the way, this recently happened to me this year in the form of Store Capital. I had a couple shares of Store Capital at a significantly lower price than what it originally was bought for. And, you know, I think I made like around like $500 for the shares of Store Capital that I originally bought for, I believe, like, I think it's like $28 or $27. And a company bought it, I think it was Oak Street Capital, I think, bought it for $32 and change. So I made good on that deal. So all in all, you guys may want to consider this. Now, with all of that said, let's get into the wheel. There's a lot more recommendations, so I've added them. And let's see what kind of stock we should do today for this video for the stock analysis. So let's spin the wheel and see what we get. And we got the company, guys, DFS. Very, very nice. And I believe this one was the one that was just off the hair a few days ago. And unfortunately, it went to the other one. But yeah, we finally got the stock, guys, DFS, which was brought up by none other than Eli. In fact, here is the comment where Eli recommended this stock. So congratulations, Eli. Let's cover DFS fundamentals, and of course, what price should we pay for this company? And to my surprise, guys, this is the company Discover. I actually have done this company a decent amount of times on the channel, I believe 2 other times. In fact, the last time I did this was in October. So of 2022, obviously. And yeah, let's actually take a look at these fundamentals, guys, and see if at the current share price, this is a buy. So let's take a look at the earnings summary. I'm not gonna go the entire earnings report. However, I will have it linked in the description below. We got their EPS normalized actual coming in at $3.58, which was a miss by 32 cents. EPS gap actual, $3.58, missed by 31 cents. Revenue of $3.75 billion, which is a beat by $38.67 million. Now, for anybody who doesn't know, this company, it is in the financial sector. And, well, we know what's been happening with the financial sector. So the fact of the matter is that they probably got hit just like all the other ones got hit, even if there was nothing wrong with them. I mean, this is a credit card company, so, you know, they're pretty, they're like Visa and MasterCard, so they're pretty insulated when it comes to this whole banking stuff, yet, you know, it's going to trickle to them as well. So this actually might present itself as a pretty good buying opportunity. Coming now to the calculator, we got the ticker for DFS, market cap of $24.3 billion and a PE of 6.47, absolutely tiny, with a current share price of $95.83. Now, full disclosure, I just took a look at the previous video I did in October. The price then was $95.86. So nothing's really going to change much from that video to this video, ironically enough. So looking at this graph, guys, when it comes to this company, you can see that on the 1 year, they're down 8.41%. Year to date, they're probably, wow, okay, I thought that wasn't going to be up. They're down 1.2%. 52-week range is $87.64 to almost $120, guys. Not 52-week lows, but in that range on the lower side, right? Really, really interesting to see. They do pay out a dividend of $2.80, which is a yield of almost 3%, 2.92 to be exact, a payout ratio of 16.16, really, really solid, and a 5-year growth rate of 12.2. This is all looking really, really good so far. Dividend growth rate, it is 12 consecutive years. So the past 12 years, guys, they have given out this dividend and increased it at the same time. Ex-dividend day is actually coming up on the 24th of this month. So let's see what the calculator actually tells us. Payout date is on June 8th, and they pay their dividends quarterly. Looking back into the calculator, based off of the current shares outstanding and this $2.80 in annual dividends, this gives us, guys, that they pay out $718 million every single year in dividends. Look at these payout ratios, guys, in regards to this free cash flow. We got, after this is paid, in their 5-year average, they're still left with $5.2 billion. And so their last year's free cash flow, it is $6.2 billion. That's an increase of $1 billion in their 5-year average to the last year's free cash flow. That's really, really good. And these payout ratios in regards to the free cash flow is really, really good. 10.41% and 12.17%. Guys, not only can they afford this $2.80, but they can continue to increase it if they so wish to do so. Jumping into now the fundamentals, let's go through these rather quickly. Net income 5 years ago of $2.7 billion to 1 year ago of $4.4 billion, increase of 60%. A decent drop here during COVID, perfectly understandable though, and massive spike after COVID, and then a realization coming back to earth 1 year ago. Guys, I'm gonna give this a 60%. Looking now at the free cash flow, this one's actually really solid. We got 5 years ago of almost $5 billion to 1 year ago of $7 billion, increase of 40% with an average of $5.9 billion. You can see here that even during COVID, they still went up slightly. The year following COVID, they went down slightly. But ever since then, guys, they have continued this ride to the upside. So I'm going to give this an 85%. Looking now at the revenue, very, very similar to that of the net income. 5 years ago of $7.7 billion to 1 year ago of almost $11 billion, increase of 43.05%. Again, the similarity comes in the form of the dip during COVID and then a massive jump after COVID the year following, and then coming back down to earth the following year. So I'm going to give this the same grade, 60%. Looking now at the assets minus liabilities, consistently increasing, all except for COVID year, which I'm going to ignore. And you can see here that as of 1 year ago to today, they did drop a little bit by around $200 million, but honestly, not too bad, guys. Average total assets, it is $120.4 billion. Average liabilities, it is $107.4 billion. Doing this difference, we get $13 billion, guys. I'm giving this 95%. Looking into the cash flow minus liabilities, caught me by surprise. We can see here that okay, they've had instances of bringing it closer and closer to zero. In fact, going from 3 to 2, that's a really nice increase. However, as of 1 year ago, they brought it significantly lower to now negative $110 billion, which it is lower than the average of negative $97.4 billion. So guys, I'm going to give this a 50%. Looking now into the shares outstanding, this is by far the best out of all the metrics, consistently decreasing, going from 331.4 million to 256.6 million. That is a decrease of 22.57% on the 5-year, and on the previous year to the current year, that is another massive decrease, guys, of 4.04%. Needless to say, this is perfect. I'm going to give this a 100%. And lastly, coming into the cash equivalents, they currently hold $10.13 billion with an average of $10.25 billion. The overall grades show us the net income, we gave a 60%, free cash flow 85%, revenue 60%, assets minus liabilities 95%, cash flow minus liabilities 50%, shares outstanding of 100%, overall grade of 75. Main problem here is, well, the revenue and the net income, it's not bad. I just gave it a 60 because I'm like, I don't know if this will continue to fall or not, right? We already have precedent that as of 2 to 1 year ago, it fell a little bit. It may continue to fall. I don't know. So that's why I gave it a 60%. You could make the argument for 70 or higher. Nonetheless, though, my overall grade, it is 75. And of course, if we take a look at the discounted free cash flow, we can see that with a required rate of return of 10%, guys, this is absolutely massive. I mean, $257.84 for not adjusting for debt, $266, guys. The current share price is $95.83. Putting in some of these revenue growth assumptions of, you can see here on Seeking Alpha is 10%. If we put, let's just say, at around, let's say 6%, let's just go really, well, let's just go lower than what they're expecting. Let's just say 6, 7, and 8%. For the revenue growth assumption, and with a required rate of return of, let's face it, they've been buying back a significant amount. They might actually continue to issue, or maybe not, they might continue to buy back, seeing that their PE is really low. They might actually continue to buy back, guys. So if that's the case, then, well, let's say at around, I don't think they're going to do 22%, but let's say at around something tiny like 5, 6, and 7% in the next upcoming years. Guys, we get now $334.71 to $365.67. Adjusting for debt, $343 to $374.50. Margin of safety of 5, 10, 15. $292 to $355. That's absolutely insane, guys. The current share price of $95.83, and with a PE of 6.49. Well, market's open right now, so this is going to change every single second. But nonetheless, though, you guys can see that this is looking like a very interesting buy, to say the least. And I believe in my last video, I said the exact same thing. Does this mean that you go out and buy it? No. Every investment is the present value of all future cash flow. Please read the earnings report. They'll be linked in the description below, just like all other articles that I've shown you guys today. Link is in the description below. And please have these calculators, make your own assumptions. I'm not here to tell you what to do. I'm not doing due diligence. I'm here to show you my basic opinion on a company that I do not own. So if you guys like to own this company, you have to understand the ins and outs of this company. So do your own due diligence, guys, not financial advice, all right? And as I mentioned at the beginning of the video, the best way that you guys can help us is by subscribing, and commenting, and of course, sharing. Thank you so much for the help so far. And looking at this dividend, guys, with almost 3% in yield, putting in $5,725, this nets us an annual dividend of $167.28, with a massive potential of this increasing in the future, seeing that the payout ratio is really low. And of course, guys, looking at the option trades for May 19th, we got over here, not bad premium in my personal opinion. Currently, the share price is up to $96, so that's why you're seeing this right now. But you can see that, you know, $85 for a strike of 95, $40 for a strike of 93 next week. It's actually not too bad. Now, if you do own 100 shares of this company, obviously, if you sell a covered call, you will get these shares taken away and you will lose that dividend. But if you don't mind that, you can see that, well, it's not looking too bad. $110, $75, $40 for a strike of like 99. So it really just depends as to what you want to do with this. But nonetheless, so this is the options change for the week of May 19th, 2023. So all in all, guys, when it comes to Discover, this is looking like a really decent company to buy right now. But again, please do your own due diligence when it comes to this. So that pretty much does it for this video, guys. Hopefully everybody liked the format of, going through a couple news and then looking at your guys' recommendations. If the channel continues to grow and we get to the point that I can make this my full-time job, I would like for this to be the format. Now, unfortunately, I can't do this every single day because, well, as I mentioned today, I just took the day off. However, in July, the first week of July, I am actually going to take an entire week off. So be prepared for this kind of format on that week. And again, if we can actually get this channel to pick up and I can make this my full-time job, then I can definitely do this pretty much every single day. So again, thank you all so much for supporting, guys. I really do appreciate it. So with that said, peace out. See you all in the next video.